Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. One of the biggest surprises for property investors isn't interest rates, it's tax. Income tax, corporation tax, capital gains tax, stamp duty surcharges, and then the constant debate about personal ownership versus limited companies. Add in the confusion about what you can and can't offset, and it's easy to make expensive mistakes. So in today's episode, I'm going to break down the main taxes landlords face, how they differ depending on ownership structure, and what can generally be offset against income and against sale proceeds, and where investors often get this wrong. This isn't tax advice. It's about helping you understand the landscape so you can structure properly and have better conversations with your accountant. Tax. I'm going to break this down into three separate parts to try and help with the understanding. So the part one is income tax, and that's if you own the property in your personal name. So if you own a buy-to-let property personally, rental profit is added to your personal income and tax at your marginal rate. And those are 20%, 40% or 45% depending on your earnings. And obviously this is at the time of recording. Those will change with different governments and as legislation changes, as bandings change, but we're just trying to keep it really simple. And as we already mentioned, this isn't tax advice. This is just trying to help people understand what's expected of them. So rental profit is simply your rental income minus your allowable expenses. And then that's where the confusion starts. So what can you generally offset against rental income? You can offset your letting agent fees, maintenance and repairs, landlord's insurance, accountancy fees, service charges and ground rent, advertising, and replacement of domestic items such as a worn-out boiler or kitchen units on a like-for-like basis. But here's the key distinction. Repairs are deductible, improvements are not. If you extend the property, add a loft conversion or fundamentally upgrade it, that's capital expenditure. That doesn't reduce your rental income tax bill, but it may help you later when you sell, but not now. And one of the biggest misunderstandings, you cannot deduct your mortgage payment, only the interest element. So even if you own the property in your personal name, you don't deduct the interest fully. Instead, you receive a 20% tax credit on the interest. So that's why people who pay 40% or 45% interest really feel the squeeze under the Section 24 changes on rental income, because you can only offset 20% of your tax credit against that interest payment. And also, if anybody has a personally owned property on a repayment mortgage, they may be in a negative cash flow situation after paying tax because the mortgage payment is on repayment, and that's not just the interest element. Okay, so that's rental income tax on property owned in your personal name. So part two is rental income if it's owned by a limited company, and this is where we look at corporation tax. So if your property is owned in a limited company, things do work slightly differently. The company pays corporation tax on its profits. Mortgage interest is fully deductible as a business expense, and that's a major structural difference between ownership in your personal name. So within the company, rental income minus expenses, including the full mortgage interest, equals taxable profit. That profit then is taxed at the corporation tax rates, and that will depend, the tax that you pay then will depend on your banding, depending on the corporation tax of your company and the turnover of the company. However, this is important. You only avoid paying personal tax if you leave the money in the company. So if you take the profits out personally, usually through dividends, then you will also pay dividend tax on taking that money out of the company. So companies can be powerful for reinvestment and scaling, but extraction can create a second layer of tax, and you have to be really mindful of that if you are, relying on the income to draw that down personally. So companies aren't automatically more tax efficient, they're more growth efficient. So if you're going to reinvest the profits, that's where the real benefit lies. So moving on then to part 3 is capital gains tax when you sell. So what we've talked about so far is rental income and tax on your income. Now we're talking about selling the property. So if you own the property personally, when you sell, you may pay capital gains tax. So your gain is based on the sale price minus the purchase price, minus stamp duty, minus legal fees, minus capital improvements, and minus selling costs. So the final number that you've got there is your gain. And residential property gains are taxed at 18 or 24%. And again, that's depending on your income level. There is an annual capital gains tax allowance. However, that has reduced significantly over the last few years. So most of the gain is likely to be taxable. But that will depend how long you've owned the property, and there might be some reliefs in that. And also, if you've lived in the property for any amount of time, that might reduce that element of tax that you've due to pay on that property. Now, what we talked about earlier is the one difference between the capital improvements, and that's an allowable expense against the sale if you've made any major refurbishments or renovations or extensions or loft conversions, as I mentioned earlier on. In terms of selling the property, if the property is owned in a limited company, then there's no capital gains tax. Instead, the company pays corporation tax on the gain. The gain after those expenses is seen as income to the company. But remember, when you extract that money, you also then pay dividend tax on that extraction. So again, structure matters. You could end up with one layer of tax personally, or 2 layers in a company, depending on what you decide to do with the money once you sell the property. So what can you offset when you sell? This is where the sort of improvements become useful. Capital improvements, this enhances the value or extend the life of the property, and that can reduce your taxable gain when you sell. So examples of these, as I've just mentioned, are extensions, loft conversions, structural alterations, or major refurbishments that add value. But they don't include basic decoration, routine maintenance, and like-for-like replacement and repairs. So understanding that distinction matters hugely over the long term, and it's important to keep records for when you do that, because you might own a property for 20, 30 years. It's important to keep records so that when you do the tax return, it's really easy to pull that information together. Some of the other taxes then, so what else does a company or a landlord face when purchasing a property? Obviously stamp duty, and that's on the way in. And again, depending on where you are in the UK, you will have different levels of stamp duty. England has stamp duty land tax, Wales has land transaction tax, and Scotland has its own version as well. And most landlords will pay an additional surcharge on residential purchases. And if you're buying mixed use or semi-commercial or multi-unit block of 6 or more flats, then different rules apply, and you may pay the commercial element of stamp duty. So companies still pay the surcharge. There's no loophole there, but it's just making sure and understanding that you do pay the correct stamp duty. If you're purchasing property for less than 40,000, there will be no stamp duty payable. And also, if the property is uninhabitable, there may be, and maybe being the operative word, a reduction in the stamp duty there as well. So just get some advice on that before you pay your stamp duty. So just some of the common misunderstandings, some of the things that we see regularly are companies are always the most tax efficient. That's a phrase that you'll probably hear quite regularly, and that's not necessarily the case, especially if you need income personally. Like I mentioned, I can deduct my whole mortgage, and again, that's also not true in personal ownership. And if I incorporate later, it's easy. Usually that's not the case, because transferring properties can trigger stamp duty and capital gains tax, depending on the structure that you've got it in, whether it's just you on your own, whether you're in a partnership and they don't necessarily trigger them. You might be able to offset some of them. You might get some deferment into the future. But again, this is an area of specialist tax advice. And that, again, like I mentioned a number of times, that we're not giving tax advice. We're just trying to highlight some of these things, common things that we see investors talking about. And I'll sort it later. Structuring decisions are far harder and more expensive to change once the portfolio grows. Now, this is the bit that's really, really difficult for people to envisage where they're going to go in the future. And when you start thinking about your strategy, as you get started, a lot of people just get started and want to crack on, and they don't actually see what that looks like. And you think you might want to grow a portfolio over a short term, or a portfolio of buy-to-lets. And then as things change, as you go through that experience, you might think, I want to do a different element. I might want to do serviced accommodation, or I might want to do commercial, or I might want to do property development. And then those types of structures and strategies might have different tax implications. So it is quite difficult to plan ahead, but what you can do is plan ahead with the best intentions on what you want to get to, and that will help that. So from a strategic thinking point of view, the key message is tax should support your strategy and not drive it. If your goal is long-term reinvestment and growth, then a company might make more sense. If your goal is lifestyle and income and simplicity, then personal ownership might work better, especially if you're in a position where you've got a higher paying job now, but you want to reduce those hours, reduce your working hours, and look to sort of semi-retirement or retirement and looking to live off your property income. So it will all of this goes into, and it depends is the answer, which is a bit frustrating at times, but it does depend on a number of things. And those main ones are your income now and in the future, your growth plans, your exit strategy, your need for cash flow, and your risk tolerance. Tax efficiency is important, but structure should follow the strategy and not the other way around. So hopefully that's been quite helpful just to understand the different nuances and the different taxes that are payable both on income and on asset disposal. And just closing then, I just really want to reiterate that this episode isn't tax advice. We are not tax advisors. We're not accountants. We're not qualified to do so. And this isn't advice. So this shouldn't replace seeking advice from a qualified accountant or a tax specialist. But understanding income tax, corporation tax, capital gains and stamp duty hopefully will give you clarity and prevent costly structural mistakes. So if you're unsure whether your current structure fits your goals, you're on about buying your next property and want to think strategically before you commit, then speak to us at Prime Property Finance. We can help you with our understanding and the financing elements, but also we can help you, point you in the direction of a tax specialist or an accountant that might be able to help you with that. So as always, tax, lending and long-term planning all connect, and getting it right at the start is far easier than trying to fix it later. So thanks for listening. Hopefully if that's been of value, as always, we look forward to seeing you on the next episode. Please share, like and comment. That feedback is really useful to us and we do value it. So thanks for those who do come back to us and comment and share. We really do appreciate it. So thanks very much and see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.